If you can all hear me, and welcome to the hope will be an interesting experience for you all, and hopefully you will learn a few things, and maybe it may even just complement things you already know. The presentation itself is, in a sense, a complement to the course I teach at ISEF, which is the second year international finance course. And so you'll see by the end of the presentation how the material corresponds to my course and what other things you would learn in this master's program. Now, let's get started. What I'm going to go through in this presentation is first what we call the proximate cause of the global financial crisis. So this is what's been quoted in the newspapers and discussed frequently of why or what started the whole crisis, which is the mortgage or the housing market in the US. But then I'm going to look at in the next section some of the characteristics of the global financial crisis and maybe some of the deeper issues of why the crisis actually occurred or why the global economy was susceptible to even small shocks. After that, I'm going to look at Europe and why the crisis in the US affected the European market so much, and most importantly, how and why the risk of the financial markets, which are, they're essentially private enterprises traded by individuals, corporations, but non-government actors, ended up causing large difficulties, extreme difficulties for governments. So essentially how private debt became sovereign debt, and sovereign debt led to sovereign default. And I'm going to focus on Greece and some of the difficulties that they face, and you'll see the enormous challenges the country has faced over the last 18 odd years. 8 to 10 years. After that, I'm going to discuss the policy responses, both in US and Europe, and these will be can be separated into two types of policies. One is monetary policy, essentially quantitative easing or unconventional monetary policy, and the second is macroprudential policies, which are really a new type of policy which has emerged in the last couple of years, and it's something that central bankers are still thinking about and still developing and refining. But the idea is that these sorts of policies will prevent the build-up of large risks and prevent sort of large episodes, global episodes of crisis to happen in the future. Finally, I'm going to, as I mentioned before, talk about how what you will learn during your degree at ISEF in the master's program, what courses will be relevant to understand both what I have discussed in the presentation and perhaps other issues that you may be interested in, and finally what the career options you would have from this degree. So let's get started. Okay, so as I mentioned, the proximate cause that has been discussed is the subprime crisis of 2007-8. Essentially what we saw since the late 90s and the deregulation of the mortgage markets in the US was the emergence of new types of financial contracts. This is what we call financial innovation. This financial innovation essentially allowed banks to extend loans to borrowers who would otherwise have been deemed very risky because the banks themselves didn't have to hold on to the risk. So a subprime mortgage is a mortgage which is below prime, which means it's risky. And it's risky because the person borrowing it may have a relatively low income compared to the value of the loan, compared to the value of the house they want to buy, compared to the value of the debt that they take on. Now, if somebody that borrows has a relatively low income, they have a very high likelihood in the future, if they lose their job, for example, or if interest rates rise, that they won't be able to repay their obligations to the bank. They won't be able to repay their mortgage. So the banks came up, or the financial markets rather, came up with a clever solution which said that let's repackage these loans and say that these loans are composed of two parts. One part which is a safe part, and another part which is a risky part. And this risky part was then on-sold to different types of investors. We can think of them as hedge funds, who are willing to take on this risk. Now, in a sense, this is definitely good because it allowed more people to get into more houses, and it generated additional liquidity in the financial markets and as well as in the housing market. What wasn't really understood effectively at that date was the fact that you can't really separate these mortgages from a risky and non-risky part. The reason is that when some people start defaulting on their mortgages, it could be because they lost their jobs, but it turns out that when people lose their jobs, it's during an economic downturn, which is the same time as house prices going down. Now, if house prices start falling, then the value of your mortgage compared to your house price is going to keep increasing. And in the US, it's quite easy to default upon your mortgage and basically just give the house back to the bank. So if a lot of people start doing this during an aggregate downturn, an economic downturn, then you have a large rate of default on these mortgages, which meant that not only were the risky parts of these mortgages defaulting, but also the parts that were thought to be safe. Technically, these were called mortgage-backed securities, and those collateralized debt obligations. So as I said, the innovation of these contracts increased the liquidity in the housing market and resulted in a steep increase in housing prices. Now, once the bubble burst, once defaults started rising, there was a big hit on the bank's balance sheets. There was also a subsequent decline in lending in mortgages. As banks stop lending to the private sector, this is going to have a further adverse effect on the real economy, and so we saw a large decline in lending and aggregate activity and GDP growth. At the same time, there was an increase in bank failures, and bank failures are extremely risky, and they affect the entire financial system. Okay. Now, some of the factors that caused the financial crisis, other than or that caused the subprime mortgages to start defaulting, one is that there was an increase in interest rates, which I'll touch on in a few slides, and there was government fiscal imbalances. So there was a fear that the government was borrowing much more than it could raise through taxes, which had a fear that inflation would have to rise in order for the government to balance its books. So all these risks contributed to the bursting of the bubble, and we see here the sequence of events in the US financial crisis. So stage one was that there's a deterioration in the financial institution's balance sheet, decline in asset prices, increase in interest rates, increase in uncertainty. Stage two is that there was a decline in economic activity, which led to a banking crisis. This led to, again, further declines in economic activity. And stage three was that because there was less economic activity, less liquidity generated, there was a decline in the price level, decline in the rate of inflation, which increased the real value of debt, which then further compounded the decline in economic activity. Okay, so we have this reinforcing mechanism inherent in the way modern economies function, which when things are going well, you see that these three stages are actually good because each stage reinforces the growth from stage one. However, if there's a decline or a negative shock, we see a very large contraction. And really the objective of policymakers, the objective of governments is one, yes, to have higher growth, but also number two, to reduce the volatility and uncertainty of the macroeconomy. So to manage the business cycle, as we say. Okay, we want stable, we want growth with low volatility. Okay, so around the time of the crisis, which was 2007-8, we saw some high-profile firms fail. One was Bear Stearns. Fannie Mae and Freddie Mac got into trouble in July 2008. Then Lehman Brothers, Merrill Lynch, AIG, Washington Mutual, all these institutions in the US had to either close or be bailed out by the government. In the UK, there was several high-profile institutions such as the Royal Bank of Scotland that also had to be bailed out by the government. Okay, so this was what happened in the US. There was a bailout package that was voted, and there was a $787 billion US economic stimulus plan that was instituted in 2009. Okay, so let's turn now to the characteristics of the global financial crisis. We talked a little bit about the increase in the beginning, about the increase in debt to households, especially debt to people that wouldn't otherwise have been able to borrow. But what was more prevalent and more general in the global economy at this time was high leverage. So we can say, yes, the financial crisis was caused by the subprime market bursting, the mortgage market bursting, but really what we should be thinking about was that the crisis was inevitable because there was very high leverage all over the world, especially in financial institutions and banks. Okay, so high leverage followed by the absence of liquidity and the pervasion of default characterized the transmission of the financial crisis from one sector of the US to the entire global economy. So what we really need to do to understand what happened was to understand the interconnectedness between leverage, liquidity, and default. Okay, and how policy, which is monetary and fiscal policy, interact with these characteristics. Let's look at some of these one by one. The first is leverage. So if you look at the approximate capital structure of the US banking sector, this was, I think, 2009-ish data. The total assets was around 15 trillion. Now, if you look at this column, you see, assets must be backed by liabilities. Liabilities and equity. So we have equity of 1.4, deposits of 8.5, but the important thing is that the proportion of wholesale funding. Wholesale funding means banks borrowing on the interbank market. Now there's three types of ways banks can issue debt. One is accepting deposits, which is basically households lending to the banks. The second is that the banks can issue bonds, which have different maturities from 3 months all the way up to 10, 20, 30 years. And the final way is through the wholesale funds market, which is what we call the interbank market. Now the interbank market is at its shortest maturity an overnight cash market, which is the market which banks can borrow cash, which is reserves, from other banks overnight at an unsecured rate. This wholesale funding market extends to maturities of up to 3 to 6 months, but essentially these are very short loans. Okay, so the increase in wholesale funding means that the banks were increasing their leverage, but they're increasing their leverage by taking on debt which has very low maturity. Very low maturity means that if interest rates suddenly rise, or the lenders in this market decide not to lend, the banks have a real problem in financing their obligations. So if you look at the bank funding structures in other countries, we see, get this pointer working, okay. Australia, Canada, Euro area. You see the wholesale funding ratio here is very large. It's from 20 to 30% all over these advanced countries. Okay, so this was in June 2012. Before the crisis, these numbers were much larger and a very significant problem. In the UK, there was a bank called Northern Rock, which some of you may know about. which was in the business of extending mortgages, and it had essentially two types of funding in the end. One was deposits and the other was short-term funding through the interbank market. So when the subprime crisis hit, when the global financial crisis hit in 2007, 2008, Northern Rock found it extremely difficult to fund its other liabilities, to provide enough liquidity to depositors who needed cash. And also, they found it very difficult to roll over their liabilities, their wholesale liabilities. And it got to the point where the Bank of England had to come in and bail them out, but in the end, the bank failed. So this change in maturity from long-term to short-term is another increase in risk when the global economy becomes very leveraged. Okay, so let me skip a little bit more, and we can see here the leverage ratio trend. So this is what I was saying. The gross leverage ratio of these banks started increasing dramatically from around 2005 all the way up to 2007, from 20% to around 30% for US banks. So Bear Stearns was one that failed, Merrill Lynch got into big trouble, and Lehman Brothers also got into trouble. That's why these are highlighted in bold. We can see here, which is households. So when we turn to households, we see in the scatter plot leverage growth on the x-axis and total asset growth on the vertical axis, the y-axis. And we see that leverage growth was increasing as total asset growth was declining. All right. So this inverse relationship between the two says that people were borrowing more, but on an unsecured basis. There was an increase in loans that were taken on without sufficient collateral, which is fine when the borrowers can repay, but when the borrowers get into trouble, the lenders have no way of recovering the value of their loan. Let's turn now to global leverage. So this is at the national level, what leverage look like. And there was a term that was floating around in the mid-2000s which was termed global imbalances. Global imbalances refers to the fact that some countries were running large current account surpluses and other countries were running large current account deficits. Current accounts you can think of as total income. So if some countries were sort of total income minus expenditure. So if some countries were earning a lot more than they were consuming and other countries were consuming a lot more than they were earning, it means that countries were lending to each other. And the size of these loans increased dramatically from the mid-1990s until the crisis started. So we can see here that these global imbalances were actually something that we saw frequently in the past. So this is in the late 1800s. You can see that the United Kingdom was running very large and volatile surpluses. France was also running these large surpluses, as well as the US and Japan. Now, following the breakdown of the Bretton Woods regime and the deregulation of the financial markets in the late 80s, we see that these imbalances started to take on trends. If you look at Japan, Japan was running a persistent current account surplus, as well as China, which increased dramatically from the mid-1990s onwards, while the US was running large current account deficits, as well as the United Kingdom. So what this chart should tell you is that the countries up here were lending to the countries down here, but the size of these loans were very large. So we see globally there was a lot of leverage across countries. So the question is, are they really imbalances? Well, lending and borrowing is a natural part of a functioning economic system, but what is concerning was really the size of these imbalances, these loans. Let's look at policy. So policy was heavily criticized also as being a reason for the crisis happening. Now, given that the economies were very leveraged and very susceptible to small changes in both the underlying economic situation as well as the amount of liquidity in the market. We see that in the US, which is this line here, okay, so this is a chart of interest rates, and this is time. From late 2004 onwards, the US rose interest rates by around 5% within 2 years. The reason for this steep increase in interest rates was that there was a spike in oil prices around here, and this caused US consumer price indices to rise, and the central bank, the Fed, decided to raise interest rates as a way of reducing inflation. Other countries started also raising interest rates, maybe a little bit later, about a year afterwards, but we see here this is the ECB, this is the Bank of Japan, this is the UK. So you can see up until the crisis, many countries were increasing their interest rates. At the same time, the US dollar was depreciating, which reflects the deterioration of their current account, the fact that they were consuming more than they were borrowing. Okay, given the time constraints, I have to move a little bit fast. Let's turn to Europe. Now, the crisis and everything we've talked about, at least the proximate cause or the regional shock, was in the US, but let's look at what happened in Europe. Specifically, how did these private sector loans end up affecting the sovereign? Well, the reason why European banks were affected by US banks was for two reasons. One was European banks, by Europe I mean UK plus Eurozone countries, were borrowing in the US wholesale market. Okay, so they were exposed to this short-term liability risk, the fact that the interbank market wasn't working. And secondly, they had purchased many of these mortgage-backed securities directly from US banks. So when these subprime mortgages started to default, the European banks' balance sheet started to fail as well. Now, at the same time, there was also a growth in leverage or growth in borrowing by households across Europe. So if you look at Greece, the increase in private debt to GDP from 2001, when they entered the Eurozone, until 2008-9, you see there was a dramatic increase. There was a double in the size of private debt to GDP. Same in Italy, Cyprus, Ireland, Portugal, and Spain. So this is P, I, G, S, the pigs. So this growth in private borrowing was funded by the domestic banks, who themselves were funding from the international markets. Now, as the European economy started declining, these private loans started being problematic. Private households found it difficult to repay their domestic banks, and the banks got into trouble. Once the banks get into trouble, we have what typically happens, which is the government step in, especially at least for the big systemically important banks, and the way that the governments support the banking system is either by extending loans or by directly issuing equity. But there's a question of how the governments finance this bailout support, and it's coming ultimately from the government's borrowing. If you look at this chart, we have here the sovereign CDS, credit default swaps, and here is the bank credit default swaps for Ireland. This is the date at which Ireland announced that it was bailing out its banks, September 30, 2008. And you see the spike in the CDS, which reflects an increase in default in the banking sector, was followed by an increase in the CDS for Irish government bonds, which means that the risk from the banks was transferred, from the bank's balance sheet was transferred to the government balance sheet. This chart, which I'm not going to spend too much time on, shows that the size and scale of government interventions or support of banking sectors in countries. So if you look here, Iceland had a huge amount of failed banks, Greece had a huge amount of government-assisted banks, and these are very large percentages of total banking assets. Skip through this. So Greece was one of the most severely hit countries during the crisis, and if you look at the data, it's about 30 to 40% decline in GDP since 2007, which is actually much larger than the Great Depression in the US. So this is, if not the, it is one of the most significant declines in GDP we've witnessed in modern history. So there were several ways that Greece could get support. One was they got support from the IMF, the other was from the ECB, and the third was from the Troika. This essentially means the major partners in Europe, so Greece, France, together with the ECB and the IMF. The European Union directly, unfortunately, has a clause which says that the European Union can't directly bail out its governments, which means that there's no way for these separate countries to fiscally support one of its member countries getting into trouble, which meant that the direct fiscal support which would otherwise happen, say, within the US, for a state within the US, was not available for these European countries. So the only way for them to get out of the crisis was either to somehow raise more tax revenue, get subsidies from the ECB, or get subsidies from the IMF. So since 2010, there's been still a large decline in GDP. So in the 3 years from 2010, there was a 20% decline in GDP. And you can see government debt just continued to increase. However, Greece did benefit from a large cut in its obligations. So its lenders, which were primarily French and German banks, agreed to get haircuts on the Greek government bonds that they held. And you can see here, after Argentina, this is the largest amount of reduction in the face value of debt that was experienced. So it's around 60%. Okay, so you can see here the size of the GDP. The restructuring was enormous, but it's still not enough for Greece to get out of the crisis. This is 10 years on. Okay. So this is a nice quote which says, kind of highlights the political tensions within Europe, which says that the European support program was really about protecting German banks, especially French banks, from debt write-offs, rather than for supporting the countries that got into trouble. So hopefully you start to see the interconnectedness between the financial markets as well as how politics very quickly gets into this issue and how to resolve this issue. Let's turn now to some of the policy responses that appeared during the crisis. The first is monetary policy. So the most dramatic was, well, there's two dramatic things that happened. One was the reduction in interest rates. And you see, globally, this was a spike in interest rates. And then after the crisis, there was a cut in interest rates to virtually zero in most of these European, in Europe, the US, as well as Japan and the UK. Okay, so interest rates hit zero, which was a way of reducing the cost of liquidity and allowing banks to refinance their obligations as cheaply as possible. The second was that the central banks around the world started buying assets as a way of, again, increasing the amount of liquidity in the market. So the central banks started buying government bonds in exchange for cash, which increased the amount of cash in the system, asset-backed securities in the US, which are essentially mortgages, as well as lending to financial institutions. There's direct lending in the ECB. And these other assets is purchases of other financial securities. So in the UK, there was a large amount of purchases of equities and corporate bonds. So this was all a way to increase the liquidity in the system as much as possible and prevent the catastrophic or the potentially catastrophic effects of interest rates going up at the same time as balance sheets becoming more and more constrained. The second type of policy that has emerged as one of the most important to consider, and one which is still in the process of being understood and worked out exactly how they can be implemented, is macroprudential policies. So firstly, let's understand the difference between micro and macroprudential policies. Microprudential policies are regulations which emerged since the late 1980s, but they focus on banks, the risk of individual banks. They put restrictions on the balance sheets of banks so that they individually are going to be safer and have less chance of default. Macroprudential policies, on the other hand, consider the interconnectedness of the financial system and consider how can these policies reduce the build-up of systemic risk or aggregate risk. So I'm going to go through a couple of these policies that were undertaken or considered in various places. So one is loan-to-value regulation. So we discussed in the beginning the subprime market, how it was caused by people that couldn't borrowing a lot against their houses. So loan-to-value regulation says that borrowers, if they want to buy a house for $100, can only borrow, say, $80 against the house, not $90. Okay, so it's a restriction on the amount of loan that can be given relative to the value of the asset. Okay, so this is a way of forcing the borrowers to be safer and more secure. There's a haircut regulation, which increasing haircuts result in less securitization, fewer repo loans to non-banks, raising mortgage rates and reducing mortgage extensions. Capital regulation. This was a way of increasing the amount of equity capital that banks had to hold. And this was a way not just of making individual banks safer, but the system as a whole safer. And it's recognizing the fact that banks are connected to each other, and if one of their partners gets into trouble, all the banks will be in trouble. Next is liquidity regulation, which forced the banks to hold more cash on their balance sheet. And that's related to dynamic provisioning regulation, which forced banks to hold more cash against potential losses that they may experience in the future. And really what central banks are thinking about now is not just one policy tool, but multiple policies tools, particularly in conjunction with monetary policy changes, with monetary policy and setting interest rates. All right, so that is a very quick and brief summary of the global financial crisis and the policies that were employed during and after the crisis, and hopefully will help us prevent and manage future crises, which are inevitable. So I'm going to talk now a little bit about what you will learn at ISEF and the career option that you'll face. At ISEF, you're going to take many interesting courses which will develop your skills and talents. But the courses which are going to be most relevant for studying and understanding the material that I have just presented and maybe going a bit further are going to be the core microeconomics and macroeconomics courses, which will provide a very rigorous foundation for you to understand these things at an advanced level. There's a financial economics course, which will help you understand how to think about risk and asset price movements. There's an advanced asset pricing course, which is taught by Professor Samokos from Oxford, who will help you understand about financial friction, including default and collateral constraints, and the roles of financial intermediaries such as banks. So he'll focus a lot on financial stability issues. And finally, it's the international finance course that I teach in the second year, which will cover the frameworks to think about international financial flows, contagion, and crisis. So essentially, we'll spend the whole term thinking about these issues that I just presented. You will also get the opportunity to do a dissertation, which is an in-depth research over the 2 years, allowing you to study carefully a topic of your choice and hopefully come out of your master's degree having developed some expertise in a particular issue, which would be valuable for you, whatever you choose to do after the degree. And finally, the career options, investment banking, asset management, research institutions such as central banks, for example. There are several people going on to central banks every year. as well as PhD programs. Now, there's many more career options out there. Again, I'm just focusing on the sorts of career paths if you were interested in the sorts of topics that I had just covered. But I think this is a good point to end my webinar. Are there any questions that anyone has that I can answer very briefly? There's a chat function that you can use. Okay, so I don't see any immediate questions. So if you have any questions, feel free to contact me on the through my email. So I can type this in, I think, for everyone to see. How do I change the language?
I don't know. Look, change language.
Okay, so I put my email address into the chat window, and now I'll pass it on to Professor Maxime Nikitin, who's the director of the master's program. So thank you, and I hope you found this interesting and informative.